Imagine this scenario, because I guarantee some version of this has really happened to you or someone you know. You graduated from university a few months ago. You just found an apartment you really like. Good location, fair rent, close to your new job. The landlord hands you a rental application. You fill it out. You have a steady paycheck. You have never missed a bill in your life. You feel confident. Then the landlord checks your credit report. She comes back with a strange question. You have no credit history at all. Can you find a cosigner? Or pay 6 months of rent up front? You did nothing wrong. You have never been in debt. You simply never had a credit card. So there is nothing on file to check. And now, having zero debt is costing you almost as much as having bad debt would. This is not bad luck. This is how the entire system quietly works. And once you understand it, you will never look at your first credit card the same way again. My name is TJ, and I spend a lot of time thinking about the money rules nobody actually sits you down and explains. If you have been avoiding credit cards because you heard they are dangerous, or if you already have your first card sitting in a drawer because you are scared to use it, make sure to hit that subscribe button and give this video a thumbs up. Because today, we are not talking about how to rack up debt, and we are not talking about rewards points either. We are talking about an accounting problem almost nobody explains clearly. One you're quietly building for yourself, or against yourself, every single month you do or do not use credit. Here is the advice a lot of well-meaning people give, parents included. Avoid credit cards completely. They are a trap. Just use a debit card and you will never have a problem. That advice comes from a real place of caution, and debt genuinely can cause serious harm. But it treats no credit and good credit as the same thing. They are not the same thing at all. One is measured and trusted. The other is simply invisible. And invisible gets treated exactly like risky. Let us look at two people. They were same age, with same income, and both just graduated from the same spring. The first person avoided credit completely, exactly the way they were told to. No credit card, no loans, no debt of any kind, ever. The second person opened one credit card at 18, a small limit. They used it for one thing, their phone bill, and paid it off in full every single month, without exception. 5 years later, the first person applies for that apartment and gets asked for a cosigner, or an upfront deposit worth thousands of dollars, because there is no file on them at all. The second person applies for the exact same apartment, gets approved within minutes, and never even meets the landlord in person. Same level of responsibility, same complete absence of debt problems. Wildly different outcomes. The system was never built to reward the absence of activity. It was built to measure activity. No activity looks identical to risk on paper, even though in reality, it is nothing like risk at all. You might be thinking, okay, that is one landlord, one unlucky situation. How does this actually show up in the rest of my life? Let us do a full audit of where this quietly costs people money, the same way you'd audit any hidden expense. Start with phone plans. Carriers check your credit before letting you get a phone on a monthly contract. With no credit history, you are often required to pay a deposit up front, sometimes $200 or $300, just to get the identical plan someone with a credit file gets with no deposit at all. Move to car insurance. In most places, insurers factor credit history directly into your monthly premium. Two drivers with identical driving records, same age, same car, same location, can be quoted noticeably different rates, purely because one of them has an established credit file and the other has nothing on record. Then there is utility setup. Some electricity and internet providers run a credit check before connecting service in your name. No history again means a deposit, sometimes a significant one, just to get the lights turned on in your own apartment. Even certain employers check credit as part of a background check, particularly for roles involving finance or trust. Not because a thin file makes you look dishonest, but because it gives them nothing at all to evaluate, and unexplainable gaps make evaluators nervous by default. And then there is the big one down the road. When you eventually want to finance a car, or buy a home, having no credit history does not make you look safe to a lender. It makes you look unknown, and unknown gets priced exactly like risky, because the lender has no data proving otherwise, so they default to charging you more to protect themselves. Add all of that up over just a few years: deposits, higher insurance premiums, worse loan terms, and the total cost of having no credit history at all can genuinely run into the thousands of dollars, all for something that felt like the cautious, responsible choice the whole time. There is a real psychological reason this catches so many people off guard. It feels completely logical to assume that avoiding debt entirely is the safest possible path. No debt should mean no risk, full stop. But credit scoring systems were never designed to measure whether you are financially responsible in some broad, moral sense. They exist specifically to measure whether you have a track record of borrowing money and paying it back reliably over time. If you have never borrowed anything at all, there is simply no track record to measure, good or bad. The system cannot distinguish between someone who avoided debt because they are disciplined and someone who avoided debt because nobody would extend them credit in the first place. Both look exactly the same on paper, blank. This is not a judgment on your character. It is a limitation in how the data works, and understanding that distinction is what actually lets you stop fearing the tool itself. Now, I know what you're thinking. TJ, isn't opening a credit card exactly how people end up drowning in debt in the first place? And you're right, it absolutely can be, if it is used carelessly. But the danger was never the card itself sitting in your wallet. The actual danger is carrying a balance you cannot pay off and letting interest compound on it, month after month, quietly growing while you're not looking. A credit card used correctly is not a debt trap waiting to spring. It is simply the specific tool the system happens to use to measure your reliability. It only becomes dangerous the moment you stop treating it as a measurement tool and start treating it as extra income you didn't actually earn. So here is exactly what to do, whether you are getting your first card or you already have one sitting unused in a drawer right now. Pick one small, predictable expense to put on the card. A phone bill, one streaming subscription. Something with a fixed, low monthly cost you already budget for regardless. Set up automatic payment in full, every single month, pulled directly from your checking account. Not the minimum payment listed on the statement. The entire balance. This single step is what actually protects you, because it means you are never carrying a balance that accumulates interest in the background. Do not treat your credit limit as available spending money. If your limit is $1,000, that is not $1,000 sitting there for you to use. It is a number the bank uses to evaluate you, and using close to all of it, even if you pay it off in full afterward, can actually work against your score, because it raises what's called your credit utilization, one of the bigger factors in how your score gets calculated. Leave the account open. Once you've used a card responsibly for a while, leave the account open, even if you eventually stop using it often. The length of time an account has existed is part of what gets measured, so closing your oldest card later on can actually hurt you more than help you. If a parent or guardian has had a credit card open for many years and is willing to add you as an authorized user, ask about it directly. Depending on the specific bank, their account's age can sometimes reflect onto your own file, which can meaningfully speed up how quickly you build a usable history. Here is the direct comparison worth sitting with, side by side. Managing one small credit card responsibly costs you close to nothing. At most, a few dollars in interest if you ever slip on a payment date, which is entirely avoidable with automatic payments set up from day one. Having no credit history at all, over just a few years, can cost you thousands of dollars, spread across security deposits, higher insurance premiums, utility deposits, and eventually worse terms on the loans that actually matter: a car, an apartment, a first home. None of this is an argument that debt is good, or that you should recklessly start opening dozens of accounts. It is just an argument for understanding the specific, mechanical rules of the game you are already playing. If this breakdown helped you, do me a favor and hit that like button, It genuinely helps this video reach more people who need to hear it. If you haven't already, hit subscribe too. I've got a lot more of these breakdowns coming. And if you're ready to start building your credit history today, everything you need is already right here in this video. Thanks for watching, and I'll see you in the next video.